Hello everybody, this video is entitled "The Future is on Sale, Worst Fall Ever." And by fall, I mean the season. As far as my remembering goes, I don't remember a fall being so bad back to back. Bad October, bad November, worst December. It's been bad. It's been just bad. So what's going on? What's happening? Well, first of all, if you look at the indices in general, and CNBC commentators or etc., they say, the markets are at all-time high, the markets are doing well. That's because they just look at the index. If you actually, step away from the index and step away from the Max 7, a lot of the risk assets are not doing well, right? For example, the reason why the Nasdaq is doing okay today is Tesla. The reason why a lot of our portfolios are okay today and not a catastrophe is Tesla. Tesla is my number one position. But you gotta wonder how much of the tip of the market, the top of the market, how much of that outperformance is actually due to passive flows, always buying the indices, and maybe buybacks, especially from companies like Apple. Make no mistake, if you are a stock picker, which I am, if you're a stock picker, this was likely a very bad day for you because all of the growthier stocks were way down today, way down. It just so happens that my number one pick was also a Max 7 stock, which is Tesla, and so Tesla kind of saves us. But it's like if you want to go dig into whatever is not a Max 7, you're going to be subject to these crazy outflows that are not related to fundamentals. It makes very, very little sense. So the first stock I want to talk about, of course, today is HIMSS. HIMSS continues to be down. Last week was awful for HIMSS, and it continues to be bad. We're down 2.5%. We're down 3% at some point with HIMSS. And HIMSS, just like NVIDIA actually dropped too. Not as much, but back a few weeks ago, NVIDIA dropped after a Q3. HIMSS had an amazing Q3. Everyone was surprised by how good the Q3 was at HIMSS. The business is doing stunning under the hood. HIMSS is executing so well, so fast, but HIMSS is the market's favorite punching bag. That's what it is. This is Mr. Market, and this is the HIMSS branded punching bag, and that's what the market does. The market just mistreats HIMSS. The valuation is stupid cheap. I cannot understand why HIMSS is trading at $36 still. It's being sold off with the growthier part of the markets. That's all it is. I consider HIMSS to be a steal at these levels. As a reminder, HIMSS, and it has expanded since my early coverage of HIMSS on the channel. I've been covering HIMSS for a while. It's a digital doctor plus a digital pharmacy plus digital labs, right? You can do it and get it analyzed online, and you'll have a Lancet being mailed to you in the future. So remote labs plus customized compounded pills and medication with the use of AI minus insurance, and it's all of this together. And that's why I often compare HIMSS to a potentially a big tech company, because this combo could disrupt a bunch of the pre-Medicare insurance industry, a bunch of the employer-led insurance industry. It could disrupt mom-and-pop doctors. It could disrupt pharmacy networks. That's how much it could potentially disrupt in the long run, because it's putting that entire business model upside down by providing a much better service at a much cheaper price. So that's why I say HIMSS is one monthly cost, cheaper than copays, and that's something that could disrupt pretty much insurance until you get the big issues. Like, I don't think it's going to disrupt cancer treatment, but anything before the big issues, I think HIMSS could really take away the cash cow from the medical sector and become kind of a black hole for anything medical over than the big stuff. Any medium issue, I think HIMSS could become a black hole. The market, of course, doesn't see that. The market dismisses HIMSS. First, it dismissed it as an ED pill company. Then it dismissed it as a cheap marketing company. Today, it's dismissing it as a GLP-1 company. Who knows what it's going to dismiss it as? Like I said, HIMSS is the punching bag on Mr. Market. But this valuation is nonsense. It's ridiculous. This is a stock growing at 47% growth next 12 months year over year. The margins are great. EBITDA margins growing. Everything's doing so well with this stock. I cannot understand why the market is just not rewarding stocks that are doing well. Moving on to stocks that are doing very well, that are not being rewarded on the market. So SoFi, of course, has a lot of coverage. online. I don't cover it in the day-to-day. But SoFi and Robinhood, to me, I mean, they have a different strategy, right? SoFi started with lending, trying to go into brokerage. Robinhood started with brokerage, trying to go into lending, but also personal banking and all that sort of stuff. I call this the neobanks. And in my view, the neobanks are disrupting. They are the future. The younger people, they're going to bank with neobanks. They're not going to want to go to Wells Fargo or Bank of America. And I look at the disruption of branches, very similar to HIMSS disrupting mom-and-pop doctors and disrupting pharmacies. I view SoFi and Robinhood kind of going after the disruption of branches. I could put Ally in there, but Ally is not doing as well. But it's the disruption of branches. These stocks are in my mind, in no doubt, the future. That's why I say the future is on sale. I watched a recent interview from the CEO of Robinhood talking about how you now have people in their 60s who are moving their money to Robinhood for the match. And you have people who are moving more and more money to Robinhood because they want to get that very innovative 1 to 2% match depending on the season. SoFi is also doing well on a lot of stuff, going into IPOs. We will see the marketing powerhouse that SoFi has been, with a World Cup next year on SoFi Stadium. I think that's going to give a lot of visibility to this company. Both companies keep growing at more than 30% a year, roughly. Actually, Robinhood growing a little faster than SoFi, but SoFi expected to grow faster as they are putting crypto back into the business. So I don't understand why this stock sold off. The market is indiscriminately selling great companies. It's indiscriminate sell-off. The indices are holding up because of Max 7, but the companies that are performing very well under the hood, that are small caps, are just not doing very well. Moving on to another stock, and I keep pounding the table on this one. It is Nebius. Nebius, I look at it as potentially a AWS of GPUs, a AWS of graphics computing, of AI compute, and AWS of AI compute. That's the way I look at it. Unlike a lot of the bare metal providers like IREN, or like a lot of the miners want to go into AI HPC, they're going to be more bare metal. Nebius actually provides a software stack along with the hardware, and that's what makes it special, and that's what has allowed it to gain a partnership with both hyperscalers. They had Microsoft and Meta. The stock reacted positively when the Microsoft partnership was announced, because it was announced in September, and the market dumped for the Meta partnership. And so I have a feeling, it made very, very little sense. Like okay, one hyperscaler makes it pump, another hyperscaler makes it dump. It's as though the market, depending on the season, will react positively or negatively, and is entirely ignoring the numbers. It's just focusing on the headline. Oh, Microsoft good, Meta bad. Well, guess what? Meta partnered with another Bitcoin miner not too long ago, and their stock popped. So it makes very little sense. The only thing that makes sense when I look at Nebius is that they are guiding into 2026, year in 2026, between 7 and 9 billion of revenue at the end of 2026. Trailing 12-month revenue is 500 million. So they're going to go from 500 million to, let's call it 8 billion, right? So from 500 to 8 billion. So that's a 16x, roughly. That's roughly a 16x revenue. So we don't know, of course, there's a little uncertainty, but next 12 months, in my view, they're going to grow their sales anywhere between 10x and 20x. Okay, and so that means that any number you look at on a growth-adjusted basis, if you just look out 1 year, this stock is just too cheap, because in 1 year, this stock could be trading at less than 2 times revenue, right? For a company that is already profitable, gross margin is 54%, EBITDA margin is 19%, this company is going to get more profitable. For also an enterprise value that is misleading, because they own a company called AV-Ride, and a lot of legacy auto may partner with AV-Ride for their self-driving systems, right? Because a lot of them don't want to partner with Google, because Google's too powerful. Or some companies may partner with 2 partners anyways. And then they own 28% of ClickHouse. And ClickHouse, of course, is possibly a competitor to Snowflake and Databricks. It's possibly a company who could take over Snowflake and Databricks. ClickHouse being used for giant databases. And so that's probably a business that's much more value. So if you were to remove the value of AVRide, remove the value of ClickHouse from the $19 billion valuation, you might actually get a company that is much cheaper on a multiple basis. It makes very little sense. This company is just not taken into account by the market. The market is not looking at this company. Not to mention, if you look at even the startups using them, Cursor, right? Cursor is huge, and they're using Nebius. So to me, this company is just too cheap. And who knows if they announce another deal coming up. I find it just too cheap. I love the margin of safety. Or I love the team too. The team, of course, of Nebius, the leadership team of Nebius, is the former leadership of Yandex. Yandex was the Google of Russia. That's why they come with equity stakes in innovative startups like that. So it makes no sense to me. I've been covering Nebius ever since they IPO'd. And yeah, like I said, this stock, in my view, should be higher given how they have executed. But then again, HIMS should also be higher. And SoFi should probably likely be higher. Perhaps Robinhood is fairly valued roughly, but SoFi should probably be a little bit higher. Anyways, moving on to other stocks that are being sold off. And I'm mostly going to focus on CleanSpark, but keep in mind when I talk about CleanSpark applies to a lot of the miners out there. CleanSpark dropped 15% today. What is that? 15% on what? On a Bitcoin drop of only 5%. CleanSpark dropped 15% today. CleanSpark, we know they are transitioning to AI HPC. We know the CEO said a possible deal is imminent. They are in talks with 2 hyperscalers. Is it Meta? Is it Google? Is it Facebook? Is it Microsoft? I don't know, but they're in talk with hyperscalers. But it doesn't really matter. They don't even need to talk about AI HPC because this stock is too cheap on the face of it. This is the full year 2025, right? Their last quarter was Q4. So full year 2025, they did $823 million in adjusted EBITDA. The market cap is $3,050 million. $3,050 million market cap divided by $823 million. You have a company that's trading at 3.7 price to adjusted EBITDA. But it gets much better because they have a Bitcoin bag. They have an enormous Bitcoin bag of 13,000 Bitcoin. So if you take the low price of Bitcoin of 86,000 right now and you remove the 1.1 billion worth of Bitcoin that they have, you remove that from their market cap, you get a Bitcoin bag adjusted price to EBITDA of 2.3. This stock is literally trading at 2x their EBITDA. Not to mention, they are still growing, they are still expanding, but the mining difficulty, and this is noteworthy because it hasn't happened in over a year, the Bitcoin mining difficulty is dropping, right? We were at 152 plus T, and we are now at 148. The mining difficulty is dropping, which means that all these miners are going to be mining a little more Bitcoin. As Bitcoin drops, a lot of miners come offline. That's what happened. A lot of miners have been coming offline because they don't become as profitable when Bitcoin is 86. CleanSpark is still profitable. So anyways, same story goes for IREN, for Mara. It makes no sense that these stocks are dropping so hard. The correlation with Bitcoin is just too strong. And the market is ignoring AI. The market is ignoring the value of the power. It's ignoring AI. It's just dumping these stocks, grouping them in baskets, and selling them off. Not to mention, these stocks are heavily shorted. So again, investing in this market is not for the faint of heart. And I will conclude with 2 very much unrelated stocks who are small caps, who you will find were also punished. So Zeta, as you know, I've talked about Zeta a few times on the channel. I like it very much. I think it's a Palantir marketing company. They have something kind of like an ontology, but for marketing, which is very interesting. Now minus 5%. And then I'll conclude with Rocket Lab, right? Totally unrelated to everything that we've been talking about, aside that it's growth, minus 10% today. And keep in mind, Rocket Lab has in common with a lot of the companies that I've just covered, Rocket Lab has in common the fact that it's doing so well, right? Rocket Lab had a huge success with a major mission that they succeeded. Huge success. You'd think in the morning, people think, oh, the stock's going to go up. Now, it's down 10% because they had a huge success. Well, doesn't that feel like Nebius? Down a lot because they've had a huge success with Microsoft and Meta. Doesn't this sound like HIMS? Down a lot because they've had a huge success with their Q3. This market is making absolutely no sense. It almost makes you believe if any bad news were to hit the market, sometimes I wonder if the stocks wouldn't go up. I really do. This market makes absolutely no sense. Investing in the 2020s is not and has not been for the faint of heart. And if you are successful, you deserve every praise and every dollar that you make, because this is not a market like the 2010s. This is a much tougher market than the 2010s. Believe me, I was investing throughout the 2010s. I found it much easier than investing in the 2020s. Anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.